Hey guys, Chris Cimorelli here for True Options Masters, and I like to tell our first-time options traders that options do not have to be complicated. And we've got a lot of pros here who can show you how simple options trading can be. But that's not what we're going to talk about today. I'm sitting here with Ian King, and he is one of our jack of all trades at Banyan Hill. And Ian does everything. He has a killer track record in his stock service. His crypto service has set records at our company, and not to be outdone by anyone, now Ian is venturing into the options market with a completely different, brand new strategy that we've never shown anyone before. And Ian, I'm excited to talk to you about this because, you know, there are so many different option strategies out there, but there's one in particular that you really felt confident about, that you knew you could, you know, rack up some nice, consistent, and even pretty sizable wins with. So just go ahead and start. What are we here to talk about today, Ian?
Sure. Thanks for having me, Chris. Thank you for those kind words. I'm really humbled by that. I think the way I look at the options market is, you know, where is the individual retail investor's edge? And I find that in a lot of the services that retail investors subscribe to, sort of are similar: buying puts, buying calls, you know, right, maybe selling covered puts. I wanted to create a service that was a little bit different than what everyone does. It's a little more complex. It's going to take, you know, maybe a few minutes of everyone's time to kind of learn the trades, but I outlined them. And it's based on the idea that the market tends to move sideways for longer periods of time than it moves up or down. You know, the market stays in a range, which on the bottom is, we know, is support, the top is resistance. And so I basically created a strategy that helps you take advantage of these ranges. And it's called, you know, a non-correlated strategy, where, you know, you might have stocks that are going up, you might have stocks that are going down, but this tries to make money on the fact that the market moves sideways. So it's sort of like agnostic to market moves. As long as we stay within a certain range, we're going to profit on each individual.
All right, I got to comment on this because people may not understand the brilliance of this. So you call these profit frames because, to your point, most of the time, I think you guys studied this, I think it's actually roughly 80% of the time, the market tends to stay in a range.
Right.
So, you know, really the most of your gains from long-term buy and hold really only comes from about 20% of the time. What do we call that? An 80-20 rule? I think there's a special name.
I think it's the power law. You know, it applies to much everything, you know.
Right. You know, in an organization, 20% of people do 80% of the work. And the reason why
not a Banyan Hill, though.
Not at Banyan Hill. Yeah. No, of course not. We're special. The reason why this makes so much sense and why this just really lit a light bulb in my head is you're not betting on what you want the market to do. You are betting on what the market actually does. Because when you buy a call, you're betting the market will go up. You're hoping and praying the market will go up. When you buy a put, you're hoping and praying the market will screw everybody else over and go down. What we're doing with these profit frames is you are going in line with what the market actually does most of the time. You don't have to, and this is what I love, you don't really have to be right on the direction. All you need is just for the market to stay in a range and you can make money.
Right. And
it's brilliant. And it makes sense. I think anyone watching this will be like, okay, yeah, that does kind of make sense.
Well, thank you. That's a great way to explain it. And then I'd also note that the most money in option trading, like if you go down and see the market makers on the floor, or you like look at the algorithms, they're all selling premium. You know, so what I mean by selling premium is you want to be short options, more options short than long for the most part, because there's this thing called time decay. So as an option contract gets closer to expiration, it loses a little bit of value every day. And if you're a seller of that contract, you get to keep that value. And, you know, if you're a buyer of an option contract, that value is just going to be eroded away. The thing that's really fascinating about options is there's this thing called nonlinear decay. So it means basically that the time decay doesn't move in a straight line from a year out to zero. It actually starts to accelerate about
the closer you get to your expiration.
So this strategy tries to take advantage of that sweet spot where you have an accelerating rate of decay about a month out. Typically what we try to do is sell one of these trades or put one of these trades on a little bit more than a month to expiration. So let's say 3 to 4 weeks in general, and then try to take it off the week of expiration before the expiration date, because the options become, if they're close to the strike prices, they become a little bit more sensitive to price changes as you're close to expiration. So that's really the goal of this strategy, is to take advantage of something that naturally occurs in the option market and also naturally occurs in the stock market. It's basically layering on one phenomenon over another, is how I put it. And, we've shown some very consistent returns in our model portfolio and our track record. This is something that I also, used to trade on my own 6, 7, 8 years ago when, I was more of an active trader in the markets.
Right. So, okay, I want to talk about the time frame for a second here.
Okay.
Before we get into too many details. You're saying about 3, 4 weeks, roughly a month. So a lot of our experts, like, they trade options that expire 2 or 3 months out. Some of them even go as far as 6 or 9 months out. Now, if you are an impatient, young millennial like myself, you don't like waiting that long. I hate to say it, but sometimes I'd almost rather be like wrong on a short-term trade than just wait months for gains on a longer-term one. And maybe that's a personality defect I should work on. But I like this, Ian, because a lot of people who try and bet on, short-term direction, they get it wrong. But again, you're not betting on direction. So I think you really are finding a sweet spot here. So it's relatively short-term options trading, but it still has a high win rate so far.
Correct. I mean, I think that we've been profitable on 7 of our last 10 trades that we've done in the portfolio. I haven't checked it recently, but it does have a high rate of success. And, you can also, if you widen the sort of frames that we're looking at, it's going to give you a little bit more risk if things go wrong, but it'll give you a higher chance of success. And if you zoom in on a frame, it's going to give you more reward, but also more risk. So, it'll give you a lesser probability of success, but it'll be less risk as well if you were to zoom in. But so my rule of thumb is I use just a major index, whether it be S&P 500, the Qs or the Russell, something that has very liquid option contracts, so you can get in and get out without paying sort of slippage, because you are investing in 4 contracts per trade.
Right.
And then, I figure out, what the direction of the range is. The one thing I'll say about using indexes is you eliminate sort of that idiosyncratic risk, right? So let's say I was to do a spread trade on Apple, and, Apple the next day comes out and warns about iPhone sales and the price is going to go down. That might impact like the indexes, but the result of Apple dropping 20% is going to be more muted on the S&P 500.
Right. You're betting on a lack of volatility. So it makes sense to trade an index as opposed to an individual stock, because you're right. Exactly. A piece of news can drop that can affect a stock.
Exactly. And I'll tell you one other benefit. When I first got in option trading 25 years ago, and then worked as an option sales trader on Wall Street, we had to pay $3,000 to $5,000 a month for different types of option analytics software. So that would be Bloomberg, which would give us our data on option volatilities, historical and implied volatilities. You're probably running a bunch of different software programs as well that the SIBO used to publish for $1,000 a month. Now all of that is incorporated right in your trading software. Right. So, if you do a little bit of digging on TD Ameritrade, and one thing I love to show subscribers is how they can actually take advantage of the different platforms that they use, because all this information is right in front of you now for the first time. It's just that a lot of people don't understand like how to read it. They don't understand what implied volatility means. What does it mean to be rich or cheap? Whether they should buy or sell options. That information is all right in front of you. You know where to look. And that's one.
Well, I've seen your course on your crypto service, and it's very comprehensive. You really go above and beyond. And I like that you do that. I like that you actually take that next step and actually try to like educate, our readers and market participants, as opposed to just like, here's the trade you're going to place, and I'm going to make you 100% reliant on me.
Right.
Well, I think it's
important. I think it's important.
That's what I really want to be able to give them is like, you don't have to rely on us forever. We're going to show you the ropes, and you do.
Yeah.
That.
And it's important that people understand like what they're getting themselves into. Right.
Yeah.
And one of the great things about option spreads in general and options in general. If you just buy a call option, how much you're investing, how much you can lose. You don't know how much you can make because it's open-ended. But if you're doing a spread trade, let's say you're selling a spread trade, you know exactly how much you can make or lose on every trade. So that allows you to position size accordingly, knowing what your risk is on the trade. And I think that differentiates, options from the stock market, because it feels like in options that you're addressing a problem with many different tools. Whereas like if you're just trading stocks, it's like trying to renovate your bathroom with just a hammer. You know what I mean? Like there's only so far you can go with it. Whereas like if you had like a toolkit, even from IKEA or whatnot, there's a lot more that you can do. And that's I think the benefit of options is like you can trade a lot of different scenarios in the market that you couldn't with just stocks.
That is absolutely correct. So I want to talk about the actual, placing the trade a little bit. So something I like about this, please correct me if I'm wrong. Mm-hmm. My understanding is you don't actually have to pay anything up front to get into these trades, correct?
Well, you have to have the margin in your account.
You have to have the money in your account, but you're not actually, like when you buy a call option or a put option, like you are spending that money. Whereas this time you just have to have the cash or the margin.
Yeah, you have to have the reserve to cover any potential losses is what they do. So, if you're doing any type of option spread trade, if you're selling, let's say a put spread or a call spread, you always have to have the amount of money in your account that can cover, your account for any potential losses. I mean, the good news here, though, is that when you're selling any of these spreads, you know exactly how much you can make or lose on every trade. It's basically a defined risk trade. Yeah.
Right. So it gives you a little bit of flexibility. And then the other part that I really like is that it pays you up front, correct?
It pays you up front in the sense that you're getting a credit in your account.
Right.
So you're selling something, you're getting credit. So think of selling an options contract like how an insurance company works, right? You basically are selling you a premium. You're buying the premium from the insurance company. The insurance company is basically collecting your money and then paying out claims if things go wrong. Option contracts, if you're selling them, are very similar in the sense that somebody is paying you as long as things stay the same and status quo is the same. More likely than not, you're going to keep that entire premium, right?
Well, insurance is such a great business because the vast majority of the time, their customers aren't really filing claims. So they're just making consistent money. And this is kind of similar. Maybe we shouldn't follow that metaphor too far. Mm-hmm. Because you say you won on 7 out of 10 trades. I think even more recently it was better than, I think it was like 7 out of 9 or something like that. So you've already proven that this can have a much higher win rate than most option strategies have 40-50% win rates. Honestly, anything above 60%, I see that and I'm like, wow. Mm-hmm. But I like the consistency here, and again, it just makes sense. It's playing the market a little bit smarter. It's doing what it actually does. It's doing what the big investors do, and they do that for a reason because it can be more consistent. And like you said, it just takes fewer variables out of the equation, and some people aren't comfortable with that. Some people don't want to, just sit on their hands and hope and pray that the trade that they're placing is going to work out.
Yeah. And I think one of the beauties of our strategy is because we're not, sitting on something for months, the strategy, if you're just rolling your contracts into a new trade every few weeks or so, you're incorporating what the market is doing as well. So let me give you a case in point. I brought up the insurance analogy, and I think it's a good one because, let's say that you are buying car insurance. The insurance company Progressive is selling you insurance. They get to keep the premium. But then at some point during the year or whatever your term is, you get in an accident or you get a speeding ticket. Well, the insurance company is going to adjust your premium. The option market works like that in the sense that, the value of the puts and calls that you're going to sell in the next trade that you do is going to be higher if the market starts to move erratically. Okay. So if volatility picks up, you're going to get more premium in these trades.
Awesome.
The same thing as an insurance company adjusting your premium higher if you're a bad driver. Option markets are very efficient in the sense that the market makers understand the volatility is going up, the price of options are going up, because our trades typically, come every week and expire every, 3 to 4 weeks. We are going to be able to take advantage of any heightened volatility in the market because we're not sitting on something that, let's say, we put on 6 months ago and we're waiting for it to expire in 3 months. We're getting in, as soon as the market moves or volatility is picking up. So we don't have to worry about that so much because it's more of a shorter term strategy.
So I'm hoping that everyone who's listening who didn't understand that at least took away from that Ian knows what he's talking about. And I think one of the reasons, as you said, you were doing this like on your own, as many as like 8 years ago. You've been trading options for, upwards of 25 years. I have a hard time believing that, Ian. You don't really look that old to me, but maybe you're just aging very well.
My wife has a great skincare routine for me.
Gotcha. Well, you live in South Florida too. Maybe there's a little Botox going on. You don't have to tell me if that's the case. But you have been trading options for a very long time. So maybe you can just tell us a little bit about your history.
Mm-hmm. Sure. So, I mean, I read a book, Macmillan on Options, which is like a famous one in college. And it was sort of during the dot-com bubble, started trading options in my dorm room, essentially, had some success. And then I was working at fixed income when I left college and went to Wall Street, but then got back into it, I guess, when I left the big bank and went to a smaller boutique shop, and we just specialized basically in crafting option strategies for hedge funds. So I've been able to, talk to some of the most astute investors in the option markets and learn from them and really understand, what essentially it is they're looking for when they put on any specific trade. I left that business, started my own fund for a while, and most of my success was basically on buying puts and selling upside calls on financial stocks during the financial crash. So that brought lots of success, and I owe the options market a lot of gratitude for that. And now I feel like I've learned all this. I've done other things in crypto and in stocks, obviously, like you mentioned, and now I want to do this because I want investors to see like how you can better manage your risk in the options market and capitalize on a specific strategy that does really well. And this is a service where we're going to open it up to other strategies as well. We're not going to just stick with this one. I think that the key is that, like, the toolkit analysis, it's like, you have to figure out what the problem is, and then you can use the right tool. There's going to be markets where we want to be buying put spreads, or selling call spreads when the market's going down. But this is sort of the strategy that we've been working on, just because the market volatility has been hinting at this is, the right one that's going to be successful. So
yeah, absolutely. Well, I mean, I trade IWM a lot. That's the ticker for the Russell 2000, and the entire past year was basically in this range. Now it dropped a little bit below that range yesterday, so we're going to see what happens next.
Yeah,
but you're absolutely right that there are certain market environments that are more conducive to certain strategies, and because you have so much experience, I trust you being able to kind of determine, okay, this is the right strategy for right now. And I think that's a lot of problems with certain traders is they stick to one thing, and that's going to do really well in certain environments and not so well in other environments. So I really like hearing that you can be flexible. And again, that's just going to educate, our readers, our participants even more in just understanding how to read the market the way you do. So I'm very excited about that.
Thanks. And, I'd also mention, there are times when you just don't want to trade at all. I mean, I think the best trade you can make most of the time is no trade at all. And, even recently we've gone a couple of weeks without putting a new trade on, just because I found that when the market is in what I would call price discovery, whether that be on the upside or the downside, it's very difficult to sort of nail it into a certain profit range. And for me, it's like protecting and preserving capital is key. And then, making money on the natural tendencies is probably second. So, I'll be the first person that'll say, just turn the switch off right now, because, I would rather not take the risk on something that I don't think is as certain as it typically is. So,
well, and I got to be honest with you, like I don't really have an opinion on what the market's going to do next. I'm kind of agnostic on the market as well, which is one reason I'm excited that we're putting this in front of our viewers and readers right now, because, S&P 500 has been going up and up and up, but, yesterday, the small cap market did actually break out of a range to the downside. So,
right.
it's really kind of hard to determine, I think, what's going to happen next. 2020 was great for smaller stocks. 2021 was great for bigger stocks. And now people are talking about $100 oil again. It's just like, where are we going? I thought the market was shifting towards like hyper innovation, and now it's moving out of that stuff back to oil. So I love that you have something that can kind of, zig and zag with the market than rather just hoping the market comes back into your favor again. So I appreciate that. I can't tell you how much.
Yeah, we don't hope in this strategy. We trade what's in front of us. I
Right.
think that because it has shorter time frames, it gives you that ability where it's like, you don't really have to like sit and pray in positions. It just, you get in and you get out. It's a little more conducive towards the kind of chaotic schizophrenic market that we started with this year than in years. Then, obviously you said 2020 was great for small cap, 2021 was great for big cap. No one really knows the direction it's going this year, but we will see a lot of range bound movement, I believe, this year as well. So that'd be great.
Great. Well, I'm really excited to get this in front of our readers at True Options Masters, because this is really the kind of stuff that we created True Options Masters for. We wanted to be able to show them more advanced strategies. And that's exactly what you're going to be showing them. So we're recording this a couple of days ahead. If you're watching this right now, Profit Framing is live. You can click on the link in the comment box below. It looks like a very, very, very good video. Again, it's live. It's in the comment box below. Take a look. Ian, do you have any closing remarks for us?
I think you covered just about everything. I think you did a really thorough job asking the right questions. Yeah, I would just say, check it out. If it's not for you, it's not for you. It probably might be for you, especially if, you're just getting into options for the first time. I feel like there's a lot that can be taught. And also I want to make sure that everyone understands what they're doing, what they're trading, and then, give them a new tool to kind of conquer the markets, whatever it might throw at them in the future.
I agree. In some sense, this is a bit like diving into the deep end of options, but at the same time, the trades are comprised of individual pieces. So you're trading 4 contracts at once, basically. If you know how to buy one option, you pretty much know how to do this. It's not really harder. It's just a little bit more work, instead of taking 60 seconds, it might take 2 or 3 minutes, big deal. But for, the win rate that you have been seeing, and I do want to mention this too, you had one trade that on a percentage basis went over 100%. Isn't that right?
Well, the way they calculate it is a little different. So you never really get 100%, but you do keep all of your premium. But you have to calculate it by
so
how
the
much
margin you had to
risk.
have in your brokerage account, the premium you collected was more than that margin.
Right. And that's what we try to do. So like if you're putting a spread trade on, let's say it's $3 wide, the goal is to get more than $1.50, to get more than half on every trade.
Right.
And that would be the goal. The other thing I would say about the complexity of it is that these online brokers make it really simple, where you just basically click a couple buttons and it populates the trade for you.
Yeah.
Whereas, I remember when I first started trading stuff like this, like you had to call down to the floor and basically have like different brokers leg the trade for you. One had to do like the call spread, the other one had to do the put spread. And it just wasn't as simple. Now, because of like all the algorithmic trading, is it basically there's already a market for this, because the algorithms just pair off exactly what you want to do.
And that makes it so much more exciting. This is something that elite investors have been doing for a very long time. It used really not to be widely available to retail investors. Now it is. Now you can do this. Now you can use some of Wall Street's best secrets, against them, or if not against them, for yourself. So that's very, very exciting.
But basically, you're trading against like long option buyers, though.
Right.
People who are buying long call spreads, long put spreads, you're trading against them.
Right.
Yeah.
And I just want to say this one more time. Something that really stands out to me about this is when you're targeting a higher win rate in options, you're typically settling for smaller returns. And this doesn't really do that. I think it's the best of both worlds. I think you really have found the sweet spot. I'm really excited to see, what you continue to do over the next several weeks. And again, it's live right now, Profit Framing. Check it out. Description box below. If you've got a comment or a question for Ian or I, feel free to drop that. And of course, if you like this video, please like, subscribe. We're going to get more content like this in front of our True Options Masters subscribers. Ian, thank you so much for taking the time to talk to me today, and our True Options Masters readers. I feel like you didn't exactly make it exactly for us, but we're here. We're excited. When I heard you were doing this, I'm like, oh my God, Tom Reader's going to love this. So thank you.
Awesome. Thanks for having me, Chris.
All right.